Parks Capital, where education plus investing equals success.
Hi everyone, I am your portfolio manager Rajiv Dixit, and welcome to the market outlook for the first quarter of 2023. Yes, 2023. Happy New Year to all of you from your team at Parks Capital. Aren't we glad 2022 is over? In our last outlook in October, I had left you with some key points about the market. Let's recap them first. While the S&P 500 was down 24% at the time, by breaking down that loss on a quarter-over-quarter basis, we reinforced our belief that the worst-case scenario of the inflation problem has already played out in the second quarter of last year, and thus, the majority of the losses in this correction have already occurred. Second, we also believed that we are closer to the market bottom and that the bottom formation phase of the correction life cycle is expected to be volatile and choppy. So here we are, 3 months later. Let's go back and see how things are looking now as we close out the worst market year since the Great Recession. If all you did during the quarter was listen to the day-to-day news regarding the markets, it is very easy to believe that things are starting to get worse out there. It feels a lot worse, doesn't it? Markets are up and down. There's a lot more talk about an impending recession, whether it's going to be a soft landing or a hard one, whether the Fed's going to keep raising rates or change course on a dime. It's a forest fire out there when it comes to volatility and negativity. But we talked about this last time. We warned you that by nature, bottoms are choppy. Volatility increases drastically when bottoms are being formed because the bulls and bears are conflicting with each other with their different viewpoints of the future. What might come to you as a surprise is that actually we had a great quarter from a market performance point of view. Yes, markets were up in the fourth quarter of 2022. Remember this chart I showed you last time where we broke down the losses on a quarter-over-quarter basis to illustrate the notion that most of the losses came in the second quarter? And the worst is behind us? Let's see this chart now with the fourth quarter included. As you can see, things are getting better. S&P 500 grew 7.56% in the fourth quarter of 2022. Who would have thought that was possible in the midst of all this volatility? But let's not get too excited yet. By no means am I saying that this means all is clear in terms of market correction, that the chop is over. What it simply means is that the case for the worst case scenario being behind us is only becoming stronger. The probability of being closer to the bottom is increasing. What is certain though is the fact that we have just completed the worst calendar year in terms of market performance since the Great Recession of 2008. No one can change that fact. So, let's just talk about that a bit more. I just showed you the quarter-over-quarter performance of the S&P 500 for the year of 2022. I'm about to share for the first time with you another set of numbers. But before I do that, I want to explain what this data is and what it isn't. As clients of this firm, you all are used to seeing your portfolio performance numbers in our wealth reporting platform, Black Diamond. You know that you can log into Black Diamond and see your own portfolio performance at any time and compare it to the S&P 500 and other indices for different time periods. What you don't see is another set of performance numbers we call firm performance. So, what is firm performance? All of you have different goals, risk tolerances, withdrawal rates, etc. that makes your portfolio unique. Firm performance takes all of your performances and combines it together to derive the performance of all assets managed collectively by Parx Capital. It includes every single dollar managed, every withdrawal taken, every deposit made, and every fee collected. Everything together as one portfolio. Why is firm performance important? Because it is the real test of the investment strategy that we use to manage your money across the board. I am telling you this before I share the firm performance with you because there is a strong chance that your individual performance is going to be different than the firm performance numbers you will see shortly. But that is because your portfolio is custom designed for you. I hope that makes sense. If at any time you want to discuss the reasons why your performance is so different than the firm performance, please don't hesitate to call us. So here are the numbers. This is the same chart you saw earlier, but now with the Parx Capital firm performance numbers. In Q1, the S&P 500 was down 4.60%, while the firm was down 3.10% net of fee. In the second quarter, where most of the year's losses came, S&P 500 was down 16.10%, while the firm was down 12.13% net of fee. In the third quarter, S&P 500 was down an additional 4.88%, while the firm was down 2.68% net of fee. And in the last quarter, the only quarter that has a positive return for the market, the S&P 500 was up 7.56%, while the firm was up 5.91% net of fee. At the end of the year 2022, the S&P 500 was down a total of 18.11%, while the firm was down 12.17% net of fee. What does this mean? It means that for the year 2022, our overall strategy was able to avoid 33% of the downside of the S&P 500 Total Return Index, or in other words, avoid 1/3 of the downside. You all know this well. The primary goal of our investment strategy is to lose less than the market when markets go down. As you just saw, we did achieve this goal in the past year, a year that has been one of the hardest years to manage since the Great Recession of 2008. We lost 1/3 less than the market. And that is great. Of course, there is no guarantee that this will happen again and again in the future, but it does give us some assurance that the strategy has the ability to achieve what we intend for it to achieve. I would submit to you, though, that the goal of losing less than the market is only a means to an end. The end goal being that we have portfolio that provides long-term returns similar to the market, but is much less volatile than the market. Or in other words, less risk with more return. That sounds like a tall order. Less risk with more return? Well, that is what you pay us for. Today, I want to outline to you how, with a disciplined active management strategy, we can achieve that goal on a long-term basis. Now that we know that our investment strategy allows us to avoid approximately 33% of the downside, we can then calculate how much of the upside we need to capture in up markets to achieve the same or more return than the overall market. That number is 88%. What does that mean? Because we did not participate in all of the downside of the market, we get the luxury of only capturing 88% of the upside and still making the same amount of money over the long term. That's what we get for losing less than the market. What else do we get? We also now know that over long periods of time, if we consistently keep achieving this goal of avoiding 1/3 of the losses and gaining at least 88% of the upside, our portfolio will have 20% less volatility than a buy and hold strategy. Less volatility means less risk. Less risk with similar returns? Isn't that our end goal? Again, there is no guarantee that any of this will happen in the future. But what we have is a clear roadmap of how to achieve that end goal. Now that we have a better understanding of what we need to achieve when markets start to move higher, let's talk a little bit about how to achieve that outcome of participating in 88% or more of the upside. You have heard me say this before. As long-term investors, we must view market corrections as an opportunity that needs to be exploited for our long-term gain. This recent correction is no different. It has created value in parts of the market that are primed for growth in the long term and has removed excess from areas of the market that were attractive but overvalued earlier. We at Parx Capital are actively evaluating such opportunities. I want to discuss some of these opportunities with you today, but please know that this list keeps changing and evolving as more data comes in and markets move out of this bottoming phase. In the equity space, we believe that the recent meteoric rise in the US dollar, the supply chain issues of the recent pandemic, the zero COVID policy of China, and this correction has created enormous value in the emerging market space. Coming into this correction, we had very little exposure to this part of the market. Thus, there is room to grow here. We are specifically looking to invest in Southeast Asian markets like China, India, Indonesia, and others. As always, such investments will either be in the form of exchange-traded funds with focus on these markets or through investments in large-cap, robust companies that are primed for more growth and have significant presence in these areas. Another sector in the equity space that we are actively looking to diversify our exposure is the electric vehicle space, or EV as they now say it. There is no doubt that the world is rapidly moving towards a transition to electric vehicles, both in the consumer and commercial space. Till before the correction, this sector was both saturated and heavily overvalued in our opinion. Now, with the valuations coming down due to the correction and much larger number of players entering this market, we believe that it provides enormous opportunity for future growth for a long-term investor. We are looking to expand our exposure to more technology and resource-based companies. The other equity space that we are actively looking into is pharmaceuticals and biotechnology. We believe that we are currently underinvested in this space and that there is potential for enormous growth in the future due to technological developments and the potential for mergers and acquisitions in the coming years. In the fixed income space of the market, we believe that the Federal Reserve's aggressive actions to raise rates has created excessive strain on bond prices across the board. It is unusual to see such a dramatic fall in bond prices and the rise of bond yields in such small period of time. In our opinion, this has created opportunity in the fixed income space where our exposure was relatively light before the correction. So there is room to invest here. This kind of opportunity does not present itself often in the fixed income space, so we're definitely excited about it. This is a good time to transition into our discussion about the economy, inflation, and of course, a possible recession. I would tell you that in most normal economic scenarios, if the Federal Reserve was to attempt to raise interest rates as aggressively as they have in the past year, you will see unemployment rise, consumer spending decrease, inflation pressures reduce, and an overall decrease of economic growth, if not a complete halt of the economy. But these times are anything but normal in nature. The Federal Reserve has raised rates at an unprecedented rate in its zest to control the inflation problem. And yet, there hasn't been any meaningful effect on unemployment, consumer spending, and economic growth till now. It is our view that the reason this time the rate hikes had much less of a negative impact on the economy is due to the $5 trillion that the government pumped into the economy in 2020 to combat the effects of the pandemic. This federal stimulus resulted in historical levels of consumer and business savings. Think about it. If you already have a lot of money saved in your bank, the rise in interest rates to borrow money has much less of an impact on your ability to buy goods and services because you are more likely to use your savings than credit to buy them. Same is true for businesses. If businesses are flushed with cash, they are less likely to make significant reductions in the workforce and capital spending because they don't have to worry about borrowing cost as much. So, interest rates matter less to them than before. Inflationary pressures, on the other hand, have started to come down a little bit in the past few months. That could be the outcome of the decline in oil prices and the relief in global supply chain issues. The big question from an economic point of view is that what will last longer? The consumer and business savings, or the Federal Reserve's resolve to keep raising rates at this pace? That is where the answer lies of whether we're going to have a meaningful recession or not. We currently believe that if inflation continues to slowly come down, the Federal Reserve will slow down its rate hikes and maintain the federal funds rate at near the current levels. As you all know, we have a new employee, Meg Prokop. She's an extremely bright young individual who comes to us with a degree in economics and a strong passion for research and education. Meg and I have been researching the similarities and differences between the economic conditions of 1980-81 period and now, so we can better understand the possibility of a recession that is deep, shallow, or doesn't happen at all. Soon, we will publish a white paper with our findings for you to enjoy. If you viewed our last Outlook video, you know that we believe that whether there is going to be a recession or not should have no impact on the investment strategy of a long-term investor. This is because we believe that a recession is only an economic outcome of the problem and is thus priced into the market correction much before the determination is made whether we are in a recession or not. You also know that it is the charts and not the economic forecast that help us manage our investment strategy. So let's look at the charts and see what's the game plan for the future. This is a monthly chart of the small cap index. Last time we talked in October, this chart was testing the support line we drew back in January. In the past few quarters, equity markets have been successfully testing this line and have continued to hold it. This, in our opinion, is a very positive technical sign. Our strategy remains the same. As this line gets successfully tested and markets gain strength, we plan to slowly put the cash we raised last year back to work in areas we discussed above or wherever we find the best opportunities for the future. Of course, if this line was to meaningfully break, we would be readjusting the portfolios again and raising more cash to wait for the next support line. I want to remind you again, the purpose of this update is not to predict the future. No one can do that. The purpose of this update is to inform you of what we are seeing and how we are preparing for it. Of course, if things were to change between now and the next update in 3 months, we would be reporting about those changes and how we adapted to them in the next update or during our next conversation. We cannot close this piece without highlighting one obvious fact. The above views of the market and the narration of the events is a general view. You know, every portfolio in Parks Capital is managed based on who you are, and thus they all look a bit different based on your risk tolerance and your individual goals. Please keep that in mind. We are looking forward to talking with each of you in your quarterly meetings. Remember, education plus investing equals success.
Here at Parks Capital, we strongly believe that a successful investor is an educated investor. For this purpose, we've created our own YouTube channel. Education plus investing equals success.